Okay, class, we're going to start here with our first real lecture of Intermediate Accounting 2. Time value money was just a refresher only, and now we're going to move into the meat of the materials. I will say we're going to start with current liabilities. As you know, Intermediate Accounting 1, you went down to the asset side of the balance sheet. Now we're going to go down the right side of the balance sheet, the claims against those assets, liabilities, and equity. It's a great course. I love this course. I would say we start out rather simply. As I like to say, it's like a torture dial, right? We're going to start with the heat on just kind of warm, and then we're just going to start turning the dial, heating it up until it's like, oh man, it's so hot, I can't take it anymore. So in other words, the materials are to get slightly harder each time, and there'll be a lot of new materials you have never seen before, and that's where it gets hard. But here, current liabilities, we cover this in Principles of Accounting, and not that differently than we cover it here. So there'll be a few nuances. We expect you to have a bit of accounting acumen here at this point. You've survived Intermediate Accounting 1, so that's good news. So let's think about a liability here. And I think one of the most important things here, it arises from obligations that exist now on the balance sheet date. So if something happens before the balance sheet date and will result in a future sacrifice, either a cash payment or in some cases we might have to provide a service, we have an obligation that we are trying to recognize on the date of the balance sheet. Now, there may be 3, 4, 5 weeks until we issue our financial statements, and so a lot of times there may be something that triggers a liability after the balance sheet date. So we have to be very careful that things we're trying to pick up occurred before the balance sheet date, and they'll be recognized on the balance sheet that we're reporting to the world. If there's a significant thing that happened after the date of the balance sheet, but would be relevant for investors, we are going to disclose that, and we call it subsequent events. And so where I worked as a chief accounting officer, we would have a query to all of our leaders throughout the world and find out had anything happened since the balance sheet date that we should be aware of. We sent out a survey that they had to actually sign, and so we would go through subsequent events to see if anything was material for disclosure to investors. But again, that would be something that happened after the balance sheet date. So this is arise from a present obligation, meaning date of the balance sheet. So there's going to be obligations to pay within 1 year. And so satisfied from current assets like cash, or satisfied creation of other liabilities. We'll look at that later. But the key point of this slide is current liabilities as opposed to long-term liabilities, are things where we're going to have to pay cash, provide a service, whatever that fulfill the obligation over the next 12 months. A good example, we'll see a slide on this. If I have a long-term debt, and let's say I have a $100,000 serial debt outstanding, and then so I have I said 100,000, so it'd be $1 million of debt. But if I have 100,000 coming due within the next year, I got to take that 100,000 out of the long-term debt, and I've got to put it in current liability. So we're always looking at all of our obligations to make sure those things that are going to have to be fulfilled in the next 12 months, they are put into current liability. Why do we care? Why is this so important? And for me, as Chief Accounting Officer, and for my auditors, there is a lot of review to make sure we have everything in current liabilities that is required. Why is that? Because current liabilities tells us everything we've got to do in the next 12 months, and we'll go compare that to current assets, everything that will turn into cash in the next 12 months. So we can look at everything that's going to turn into cash in 12 months versus things that got to pay out in the next 12 months. Then we can understand what's the liquidity of our company. And we are providing that information to investors so they can make good judgments, good decisions about whether to invest in our company or not. So you can have a company just doing great, making a lot of money, maybe even generating cash. But if they have big short-term cash crunches coming up and they don't, where are they going to get the money for that? So that would be, if current assets were much larger than current assets, you got to think about it. They're going to have to borrow money. They're going to have to do something. So that's an important measure if you want to be an investor, maybe even if you want to work there, because companies go bankrupt even though they have good businesses because they have a short-term cash crunch. And so this here helps us understand that. So some examples of current liabilities: accounts payable. We buy inventory or products and we buy it on a term, on account, and so we have to pay it over 30, 60, or 90 days. Accounts payable usually does not have interest. Notes payable are going to be a signed document, commercial paper. Income tax liability, right? We'll see this when we get into income taxes, deferred taxes in Chapter 16. At the end of the year, we're going to have an income tax liability, right? Because we won't pay it for corporations till March 15th. Just like us as individuals, we go through the year, we file our taxes on April 15th, and that's the date we cut a check. So not that much different for companies, although there are some nuances. I won't get into that. And then dividends payable, we'll look at that when we get into equity. And accrued liabilities, things like warranty expense, even salaries payable, things like that. So two major components of current liabilities: accounts payable and then notes payable. So accounts payable, short duration. This is the key point for accounts payable: non-interest bearing. So we're going to have accounts receivable from our customers who we sell to them, and they pay us on account, and we're going to buy stuff from our vendors and pay them on account. That's just kind of that's the grease that keeps business flowing, right? Accounts payable and accounts receivable. We are certainly going in accounts receivable to do evaluations of our customers before we ship them on account. Same thing, our vendors in accounts payable. They're gonna look at us and how profitable are we? Are we trustworthy to pay? And there are a lot of different things we can look at to decide if this company is trustworthy. One would be past history. Now, a trade notes payable is different, longer duration, and it bears interest. In a note payable, the one thing I'd comment on there is that the interest is paid on the last day of the note. When the note is paid, all the interest comes due on that last day. So we'll look at notes payable in this chapter and how that works. There's a lot of different kinds of notes payable: commercial paper, unsecured loans, credit lines. I'll talk about that a little bit. And there's various characteristics. And it would have lower interest rates in long-term debt because there's going to be less risk, because we know it's payable in the near future versus a longer term out there where there could be opportunities for bad things to happen to the company in the longer term. So a credit line, all the companies I work for had credit lines with banks, and if I mention Linux, we had a very large credit line. We called it a revolver. And it was a consortium of banks each year that got together and, sorry about that, and provided a credit line to companies. It would be very similar to the credit limit that you have on your credit card. So, you know, in other words, I think when I left Linux, they had about 800 million in a credit line that they could tap or not tap. That's why it's a revolver. It's like revolving debt. You can tap in, pay it, and then tap in more the next time. And so there's a commitment from these banks that we can always tap into that credit line anytime we want it and pay it back anytime we want it. And so that became very flexible. So there's a formal agreement. By the way, if we never used it, we still paid a fee. There was a fee to the bank to keep that credit line out there. Revolvers, you know, again, a very formal agreement, and it would have some debt covenants and things in it. And it could be a term of 3 or 4 years where we have this credit line outstanding. In the current coronavirus issue, you see a lot of companies going in, tapping in to their credit line right now to make sure they have cash because they had a formal agreement. The banks that provided that credit line even they know it's a very risky situation right now because that credit line was out there, they have to honor that. And I read about, I forgot which company it was, they drew down $1 billion, like right away from their credit line because it was established. They had no money on that revolver, and day one took down $1 billion to prepare to make sure they have plenty of cash for the crisis that we're undergoing right now. And so these credit lines become very important for companies. So interest, I think we just saw this in our last chapter. Face amount times the annual interest rate. Interest rates are always a 12-month rate. And then the third factor is the time to maturity, and we're talking about notes payable really here. So here's a simpler note. So here's a $700,000, borrowed $700,000 in cash from First Bank, and it's a 6-month, 12% promissory note. So that doesn't mean that we're going to pay 12% over 6 months. How much we're going to pay? 12% divided by 2, because that's a half year, we'll pay 6% interest on that, right? So again, the stated rate of interest, always, every single day, an annual, a 12-month rate. That makes it easy for company. That makes it easy for all of us to deal with different interest rates. And so we always know, and every time someone talks about an interest rate, it's a 12-month rate. So first entry, debit cash, credit the notes payable, May 1st, and then the final on last day of this note is November 1st, 6 months later, and there's $42,000 of interest, $700,000 times a 12-month rate times 6 divided by 12 months, half, $42,000. In other words, 6% times $700,000, $42,000. And so we're going to credit cash, debit interest expense for that 6 months, and debit the notes payable. So you can see in notes payable, the interest is paid on the last day of the term of that note. We call it maturity date or settlement date. A lot of different terms for that. I'm not going to cover that one right there. So accrued liabilities are things, because we're not a cash-based, we're not cash-based accounting. We are accrual-based accounting, meaning we are going to measure activities, both selling activities where we sell something, deliver a product. We're going to record revenues when we deliver that product. You know, if it's on account, debit, accounts receivable, credit revenues. So now we've moved to the liability side, and we're measuring more things like expenses, right? So we have activities being performed for us, salaries being the most common, because almost all companies have employees, and so they're performing services for us, and they're not going to be paid right away. They may be paid in 1-2 weeks. We got to gather the timesheets. We got to do all the work related to calculating the withholding amounts for governments and everything else. And so after employees' last day in an accounting period of working, we won't pay them until the next accounting period. So we've got to debit salaries expense and credit salaries and wages payable. Same thing with income taxes. We'll end a year, we know we're going to owe taxes, so we should have tax expense for that year, but that doesn't get paid into the subsequent year on March 15th. And then we'll get into interest payable here in a second. Yeah, well, in a very quick second. So let's go back. Let's look at it. We got another notes payable here. And this is an entry you will be accountable for on the first exam. And so here we've got the same $700,000, looks like it, 6-month note, 12%. The note was issued on May 1st. And when will it get paid? 6 months, let's say June, July, August, September, October. It won't get paid again until November 1st. However, here's a problem. And we'll do the first entry first. $700,000 in cash, credit, notes payable. Here's the problem. We're going to cross over the end of a fiscal accounting period, June 30th. And we're going to create financial statements as of June 30th. Well, what happened here? We've got May, because on May 1st, we borrowed $700,000. Every day that note is outstanding, we're accruing interest expense. And so we have May and June. We have 2 months that we have interest expense that will not be paid until November 1st. Therefore, what do we have to do? We've got to accrue that interest expense and credit an interest payable. Debit interest expense, $700,000 times 12% times May, June, 2 months divided by 12, $14,000. That goes right to our income statement. If we did not do this accrual entry, we would have missed interest expense that we did incur prior to June 30th. So on that balance sheet date, we've got to note our interest payable and on the balance sheet in current liabilities, and we've got to note on the income statement our $14,000 of interest expense, because that money was outstanding for those 2 months, even though we will not pay interest until later. And finally, November 1st, we're going to close it. We're going to pay the $742, and we're going to debit the notes payable because we now have paid that. We don't owe it. And remember that $14,000 we set up in interest payable? Now we paid it. And so therefore, we're going to debit that and clean that account out. But we got 4 additional months of interest. So $700,000 times the annual 12-month rate, 12%, times 4 divided by 12, $28,000. And so the important thing here, this $14,000 of expense hit last year's accounting period because it was open prior to June 30th. This $28,000 hits the new year. And so timing matters here. We're getting our income statement correct, and we're getting our balance sheet correct back on June 30th. Okay, there's a lot of liabilities that we incur related to our employees besides just salaries. There may be commissions, bonuses, but hopefully in every place that you ever worked, certainly in every place I've ever worked, I also received vacation. Meaning, if I go back to my Maytag days, I gotta take this watch off. Siri is trying to talk to me. If I go back to my Maytag days, for the first 5 years, I received 3 weeks of vacation, and what was great, after I think 10 years, I got 4 weeks, and then I worked there for 17 years, and after 15, you got 5 weeks of vacation. How awesome is that? And I had 5 weeks of vacation year 15, 16, and 17. That was really awesome. So, in other words, we are, from the company's perspective, the company's going to pay people for not working. And how did they earn that? They earn that by working. And so we're going to have to debit vacation expense and credit a vacation payable. Now, when employees are not working and getting paid, well, they're not providing activities for us because they earned that vacation earlier. At that point, we're going to debit the vacation payable and credit the cash that we paid. Hopefully that makes sense to you. And so there's some things we have to understand though before we record that liability, that vacation accrual, and that is the obligation, did it arise from services already performed? And can the absent be paid do we still owe them that as of the balance sheet date? And the payment is probable and it can be estimated. And so if you worked for a whole year, let's go back to my first year at Maytag, if I worked a whole year and never took vacation, then at Maytag, I was allowed, they still owed me 3 weeks of vacation, and that I could take that in the subsequent year. So I could actually take up to 6 weeks the next year, 3 weeks from the previous year, and 3 weeks in the next year. So, but back to that end of that first year, they still owed me, if I never took any vacation, 3 weeks of vacation. If I'd only taken 1 week of vacation, they would have owed me 2 weeks of vacation. So you have to track this. Now, in the case of Maytag, Maytag had to debit vacation expense for me and credit a vacation payable, an accrued liability. Let's roll forward to Lennox. Lennox was what I call take it or lose it company. Didn't like that too much. place, it was a negative, but people still liked Lennox and worked there. At Lennox, I also I got 5 weeks of vacation every year that I could never take because I was too busy as the chief accounting officer. But interesting point there is 12/31 comes around. I've taken 3 weeks of vacation. They still owe me 2, but guess what? It's take it or lose it. In other words, I would lose when 12/31 happened. Lennox owed me nothing because if you didn't take that vacation, you lost it. You start the next year. So if I got 5 weeks in the next year, I'd have to take those 5 weeks in the next year. I could never take anything I earned in the prior year. So think about that for a second. 12/31 at Lennox, do they owe me vacation? Answer, no. Because why? They're not going to allow me to take vacation. I lost that vacation. And so that's what, number 2, the paid absence can be taken in a later year. At Maytag, that was answer yes. Therefore, Maytag, we had to record a vacation accrual. At Lennox, answer no. You cannot take that vacation you earned in a later year. You should have taken it this past year. You should have planned and you should have taken it. And so you lost it. And so at Lennox, there was no vacation accrual, no current liability. They owed employees nothing for that. And so you can see, hopefully that helps you kind of understand how we have to think about each of these liabilities at the balance sheet date. What obligations does the company have? Have we recorded those obligations? Another thing that I was fortunate, if we think about annual bonuses, and again, you probably have not worked at a company, you guys are students, they don't probably pay you bonuses, but both at Maytag and at Lennox, we received an annual bonus, and it was based on financial performance, and there was various and sundry metrics that mattered for that. Usually those were determined by the annual budgeting process, so that was a big deal. And so if you made 100% of the budget, revenues and income, revenues less expenses, net income, then you would receive 100% bonus of whatever your bonus rate was. Now that could go from 0 to 200%, both at Maytag and at Lennox. Now what was cool, I think, about both companies is the metrics for the CEO was the same as the metric for the lowest level salaried, and these are all bonus paid to salaried people. The metrics were the same. Now, the percent of salary changed a lot. I believe for the CEO, it was based on he could receive 100% of his salary as a bonus. That was his bonus target. And I think mine was still good. I think as a chief accounting officer, I got about 45%. And then entry level kind of managers would get 10%. And so the percent of salary that you would be paid out at the end of the year would be different, but they were all based on the same metric. So what did that do? That got everybody driving towards the same performance goals. Are we making bonus? You know, so that got people motivated to drive revenues, lower costs, make money, and guess what? Who won? The executives and the salaried employees won, but also shareholders won. So annual bonuses are created out there to create an incentive for management to operate in the interest of shareholders. So it aligns the interest of shareholders with the interest of management. So now from an accounting standpoint, we've got to track, where it really got hard for me was during the year, we've got to track, hey, where are we going to be? Are we going to make 100%? And I'll be honest, in my many years of receiving bonuses, there were many years where I got 0% because we did not perform well. And there were some years where I got 200%. Woohoo! It's been kind of funny. I worked harder in the years we got 0 bonus, but you know, that's just how this worked. Now, as accountants, though, we've got to estimate, hey, what's it probable? So typically you start the year and you assume, hey, we're going to make the year. Let's accrue the bonuses at 100%. If the year's going really well during the year on the monthly financials or quarterly financials, you got to estimate the future. And if it looks like it's going to be a 200% payout year, you're just having great first half of the year, you're going to have to raise your accrual, and you're going to have to credit more bonus accrual, debit more bonus expense based on where you see the year coming out. So this whole area in accruing annual bonuses is fraught with crystal ball, right? I got to predict the future to calculate that amount out. And generally, we're talking about big numbers. 100% payout at Linux would probably been worth 25, 30 million. I'm just kind of guesstimating that. Now, there's other things, and I think these are liabilities where this is different than salaries payable or bonuses payable or vacation payable. Here's a situation where what's different here, the company got cash up front and will pay and have to provide services at a later date. We're going to get into a whole different element here. And so one part is the advances from customers we'll talk about. Gift cards, where you buy a gift card for Chili's. I like to buy a gift card for Chili's as gifts for people like the SIs in 2010 or the administrative staff. I like the Chili's gift cards, so you can do Chili's or Maggiano's. But if I buy a Chili's gift card for $25, have I eaten at Chili's? Has Chili's provided me any meals? No, they just gave me a card. So Chili's has a liability that to whoever presents that card to give them meals. And so for Chili's, they've got, when they sell that gift card, they're going to debit cash, but they're going to have a liability to perform a service for the holder of that gift card, and we'll get into that. When I think about advances from customers, I always like to use airline tickets as an example. You know, I like to go to Florida, or let's just say I love London also. Let's just say, I wish it worked this way. I'll give you one example. I call American Airlines and I say, hey, I want to fly to London, England. I love London. And they said, well, yeah, we can reserve that for you. Do you have a credit card? And I'm saying, well, you know, I don't want to operate that way. I'm going to fly there on your plane, and then if your plane is on time and you have good service and good food and everything works out well, then I'll pay you 100%. How's that work? Now, I'll probably get a click on the other end because they'll think they have a nut on the phone. So they want upfront payment before they'll reserve my seat. How unfair is that, you know? But that's how the airline industry operates, right? We pay the airlines in advance, 3 months, 6 months, a year in advance for big trips, right? So the airlines are receiving all this cash and they've done nothing for it. And again, cannot record a revenue until you perform the service, until you provide your customers with a product or a service. And so they cannot record revenues for that flight to London until they actually give me a flight to London. So in the meantime, if they have my cash, debit cash, they owe me a flight. And so we're going to debit cash. You saw this in Principles of Accounting, and we're going to credit either a deferred revenue is one term for this, or unearned revenue as another term. Different companies use different terms. And so here's an example of a magazine subscription. Not too many magazines anymore. I guess I do subscribe to the Wall Street Journal online, so I do pay them for a year in advance. So it's the same thing, even though it's online. And so when the company here, they collected $20 million in subscription sales in its first year of operation. And let's see, and they got to recognize that over the term of the subscription. And so entry one, there's two entries you'll have to know with this. They debit cash for the $20 million they received, and they credit deferred revenue, deferred subscription revenue. As they provide their customers with those subscriptions, now they're going to credit revenue. They actually perform the services, and instead of they're going to debit not cash, they already received the cash, they're going to debit and reduce that liability. So this deferred subscription liability increases with a credit as the company receives cash, and it comes down with debits as they perform the services that they owe. And when that comes down, they recognize real revenue that goes right to the income statement. deferred revenue, liability on the balance sheet. As long as that subscription is going to be fulfilled over the next 12 months, current liability. Here, it only becomes an income statement item when we actually perform that service. And when we perform that service and record revenue, now we reduce our deferred revenue, our liability, with a debit. Gift certificates. Like Chili's, we receive cash, and so we record later recognition of revenue. Now, here's one interesting thing. There could be breakage with these, that not everybody will use these. And so at some point, we may be able to recognize breakage and not recognize the entire amount of that liability. In other words, if Chili's knew that 10% of the customers on average never will ever use this, they'll lose their card, whatever, on 10%, they can reduce that liability and that expense down by 10% and recognize a smaller liability, and it will increase their revenues because they got 100% of the cash, right? But only 90%. I know at Maytag we provided consumer rebates on wash machines and refrigerators up to sometimes $100, and customers would buy that product from Lowe's or Home Depot or whatever dealer, and then they would turn in the $100 consumer rebate, and we'd send them for a check for $100. Seems crazy to me because I'm a cheap accountant. I'm going to do everything it takes to turn in that request for my $100, but 20% of people did not. Wild to me. And so we knew on historical average that 20% of the people, of the dollars, 20% of the dollars will never get claimed. So we only recorded, even though we gave people a $100 expense, $100 item, we only recorded an $80 expense. Debit, expense for $80, credit a liability for $80. And is this small dollars? No, these are big dollars. At any point in time, Maytag would have $300 or $400 million in consumer rebates outstanding. And so that judgment on how these are going to be taken really mattered because it was dollar for dollar impact to the income statement. And then another element, we are going to collect money for third parties. And my favorite example would be way back when my son was 4 years old or 5 years old, and someone had advised me, hey, give your son an allowance so he can learn the use of money, but then make him pay for stuff. And so I think it was the first year we had started doing that. It's like Star Wars was really big, and my son wanted to get a lightsaber. We're sitting down there in the lightsaber aisle at Target. There were like lots of these. And, hey, Dad, man, look at this lightsaber. It's awesome. And it was like $40. And I'm thinking, oh, I said, well, I tell you what, Michael, you got money. You buy whatever lightsaber you want. And before, he was looking at the $40 ones. You have never said, he was not more than 4 or 5 years old. He was studying these things like crazy up and down the aisle, and he found one for $20. So right off that, I saved money. I saved arguments about the $40 one because it was his money, and he bought the $20 one. Well, we went up to the head of the line in Target, and guess what? Was it $20? No, 8% tax here in Texas. It was $21.60. And he told the cash register person, well, this is $20. They said, yeah, but you got sales tax on that. He said, yeah, but your sign, it said $20. How come you're charging me $21.60? And so $1.60 of taxes. He was not a happy camper. And so I had to explain to him afterwards, well, that $1.60 is going to Collin County and going to the state of Texas. It's paying for police and roads and everything else. But I don't know if that's satisfying because all he could think about, he had to pay $1.60 extra. So let's think about Target here. They sold a $20 item, and that was their, by the way, that's their revenues. That's what they sold. But they collected another $1.60. So they're debiting cash for $21.60, but they didn't have $21.60 in revenues. They're collecting $1.60 on behalf of the state and the local governments. And so later they're going to have to compile all these $1.60s, all this 8% tax, and they're going to have to cut a check for those governments. And so that entry, we're going to debit cash for $21.60, credit revenues for $20. We got another liability that we have collected on behalf of the governments. And governments are very serious about collecting that. And I think at Lennox and at Maytag, we had sales tax auditors from all the states around the United States, always in our offices, making sure that we had paid them everything that we had collected. But from accounting, there's going to be a liability for that. At the same time, we're going to have payroll-related items, as we talk about here, where we're not going to pay our employees a salary. Let's say they make $10 an hour and they work 40 hours, so we owe them. They did $400 of work for us, so we're going to debit salary expense for $400. But are they going to get $400? No. We're going to take out from that $400 withholding for Social Security, for income taxes. We're collecting that again on the behalf of the government. So let's say we took $100 out of that check. So we're going to debit salary expense for $400. We're going to credit cash for $300. So we're going to have all these other liabilities for things we collected on behalf of various, mostly U.S. government, because it'd be state taxes there as well, and different things. And here's an example, again, for sales tax, where something, a sales made for 100, but they collected 7%. So debit cash for 107, credit revenue for 100, and there's that $7, a liability that the company is going to have to pay to the state and local governments. I'm going to stop here and break this lecture up into two for my online classes. Again, thank you for hanging with me. We'll finish up this, and it'll be a second lecture from current liabilities. Thank you.